Okay, part two, the euro versus the US dollar. The weekly chart says it all. The last 2.5 months we've just traded sideways and there's nothing to give me any indication of what's going on there. So we zoom into the daily chart. There's the triangle. At least the shorts up here worked, but I thought that we'd hold this trend line down here and we haven't. I guess I got it in my head that the dollar was going to break lower, but it hasn't. The euro's broken lower. Got down to 115.58. So clearly what's going to be important now is the 116.10 area. This is resistance and it was the high on Friday. So if we hold below 116.10, market's going to trade lower, and we break below 115.58, which would look more likely having seen the breakout of this triangle, then we're going to be back down around 115.25 and 115.15. Break below 115.00 takes us to the 500-day moving average, the green line there at 114.50. It's quite a lot of levels on the downside. And then we've also got the 100-week moving average down in the mid 114 area as well. So not a huge drop if we break below 115.00, but we could nick 40 or 50 pips out of that trade if that happens. And again, if you're selling at 116.10, then get out above 116.30, because we'll probably trade back up to 116.70. Then you've got this trend line here at in the 117 teens, I suppose I could say, 117.10, 117.20. That would be your next resistance, where we could probably try a short. And then above there we've got the 23.6% fib at 117.55. There's a lot of levels in this. It's becoming a lot less clear actually. I'm not really sure what I do, because the problem is the levels are all so close together. Even scalping it, and you get a move on, you've only got 20-30 pips on the next move, so to the next target. So this is really not much fun at all. And even on the breakout, you haven't got much scope, because you could easily bottom out just 50 pips lower down here at 115.15, 115.00. Anyway, I'll be watching it, and if I see anything decent, obviously I'll let you know. But right now, I really wouldn't even bother. US dollar versus the Canadian dollar on the weekly chart is testing the 100-week moving average at 129.82, and it has held. But you can see that if we go lower this week, there is a more important support line down at 129.20, and you've got the 200-week moving average easing up towards 128.00. So the low 129 area is going to be important, more important than where we are at the moment. Although I have suggested a buying into a long around the 129.60, 129.30 area, and you'll see why. We've got the 500-day moving average, which did hold really well at the beginning of the week. In fact, it held perfectly. We spiked down on Friday and hit the 100-day moving average at 129.60. You can see why I use these moving averages. I mean, they work. Look at this 55-day moving average. Look how well that held the move. So I don't think many people use moving averages as support and resistance levels. I don't actually bother with the crossovers. The crossovers to me don't work. They're too much of a lagging indicator. But these levels do, these values do work well as support and resistance levels. Anyway, proven here, of course. Now, if we go lower again, we've got that low 129 area, which is good support from the trend line. There's another little trend line here going back to February. I mean, there's trend lines all over this chart. But you can see where these intersect nicely in the low 129 area. So that really should be a good area of support. We're getting oversold there, so I'd like to see it trade down there. I'd like to see it trade down to 129.60, 129.30. Anywhere within that 30 pip area should be a decent buying opportunity and worth the risk, because if you break below 129.00, you're out and you're into a short. So and then you'll make back any losses as we head back down, as we head down to sort of 128.15 and probably even lower than that. But you can see why there's a lot going on here and why it's good support level as we get oversold. So maybe the US dollar can start to strengthen against the Canadian dollar on the rally. Obviously, we've got the 131.00 area from this 55-day moving average. These Fibonacci levels don't seem to be having a great effect, but we could at least pause there around the 130.50, 130.70 area. So that's it. Watch the low 129.00 area. That's going to be key in this pair. Okay, this is a weekly chart of the pound versus the Japanese yen. The only thing that really matters in this, and you've probably spotted it already, is the 100-week moving average, which has been nicely creating this little smile here and just working perfectly as a support level on this spike down in the first week of June. Bang, straight off the 100-week moving average. At the end of the month, we bounced above it, and then the next first week or last week of June, first week of July, again spiked down, hit that, bang, buyers came in. Now we're retesting it, and again it's held last week. So this really is key. 144.40, 144.30 is the value as we start the new week. If that holds, then obviously we should get a decent recovery. It's also the 500-day moving average, the green line, and you know it's worked beautifully. The 500-day and obviously the 100-week moving average often have similar values for obvious reasons. So just watch that one. That's all I can say for this chart. There's the big support level. Now if we start to break below 144.00, obviously that's gone, and we're going to be looking at 143.60, 143.20. So it's a scalping level. You know, we're buying, looking for the bounce, taking some profit, but we're ready to stop, reverse into a short, and take up to 100 pips or more actually on a move to the downside on a break of that support level. Hope that makes sense. Now the idea of me doing these videos is partly educational, so you can see the way I look at markets, and if you like what I do, you can learn from them. It's also to give you some trade ideas, of course, so I'm assuming you've got notepads out and you're taking notes of levels that you like. And when I explain it to you, if you think, oh yeah, that's actually quite a good idea, I'm going to note that down. I'm trying to explain the trades to you rather than just list them on a spreadsheet. And then you can look to yourself and think, well, I don't think he's right there, but this one looks good, I'm going to go with that trade. I'm just giving you the opportunity to filter out which trades you like and which trades you do not like. Now, this is the gold chart, daily gold chart. This to me looks like a descending wedge, which is bullish, because once you break out on the upside, which is where you're expected to break, the market rockets. Now, not very oversold, I will admit, but there is some divergence there. Divergence isn't, I'm not a big fan of divergence. I don't trade divergence, but I do take note of it when it's there. You see how this low is above this low, and yet the price is below the previous low. Right, we've got a nice bullish candle here at the lower end, at the lower trend line of the wedge. We didn't manage to break above the upside of the wedge, so we're going to have to do that before we can get really bullish. We've got to get up basically through 12.18, 12.19, which you can see is a very, very short term 23.6% fib. Once we get through there, we've got a good buy signal, but already we do have a bullish candle at the lower trend line of the wedge, as I've said. Now, it gets a bit more exciting when you look at the weekly chart. Actually, that's not true. It gets more exciting when you look at the monthly chart. Now, this is why you've got to go over your long-term charts and go all the way back, because I've had to go back to 2005 here to find a trend line which looks very sexy. This is really, really important. So you can see the longer term trend lines and indicators are always more important because more people are looking at them. You cannot ignore this. Okay, so this is a 13-year trend line. It is incredibly significant, and we are just kissing that trend line support level in the low 1200 area. 1204 was our target on the break lower, which it hit on Friday, and the reaction off there, I didn't suggest buying it down there on Friday. What's the point on a Friday afternoon? Let's just wait and see if we get a bullish candle off it, and we have done. You wouldn't want to be running a position over the weekend anyway. It's never a wise idea. So bear in mind that 13-year trend line, bang, we hit it. We bounced right off it. We've got a decent looking bullish candle on there. We've got a little bit of divergence. I would have loved to have seen this severely oversold, and it isn't. But anyway, can't have everything. We've bounced off the lower trend line of the wedge. The descending wedge is a bullish pattern. If we get up through 12.18, 12.19, this is a buy signal. And already it's worth nibbling at a long position on the open. You know, stick a stop loss below, say 11.90, and you've got a pretty low risk trade, because if this takes off, you can see we've got really significant moves to the upside. This could be the start of a big, big move up in gold right through to the end of the year and beyond. You know, this could be, this could be the start of a big bull move. Anyway, you know, you could easily be seeing a 100-point move, before the end of the year even. So a small position would be the way to go with this. Nothing too big, nothing stressful. Something you could buy, just a small amount. You don't care if you lose on the trade, but it'll be so small that you can put it to the back of your mind and you can just let it run and run and run. You can then have some short-term trades as well, of course, but having a core long position around here would make sense for obvious reasons. If you've got any questions about that, just give me a shout.